With us and early in the morning, we do appreciate, and for those who are just coming in, we welcome you. Settle down so we continue with our program. I did mention that the CS requested to come in at the closing session, so we'll allow him to do that. I'd like us to start with the reflections from day 2. We had very robust conversations, presentations yesterday, as well as a panel. I don't know whether my ushers are on standby with microphones so that we kickstart our conversation. What are some of the things we think stood out for us yesterday across the day, whether it's from a panel discussion? Are we there? Yeah, all right. Whether it was a panel conversation or a presentation, we had the Malaysia discussion. We talked about financing incrementally yesterday afternoon. What are some of the takeouts? So just raise your hand, remind us who you are, with which institution, and give us some of your thoughts from yesterday. Any? Come on, guys. Oh, yes. We have a hand up here. I think I'll be there sooner than my team would be.
Good morning. My name is Violet Wanjiko. I am with Revenue Stream, financial literacy organization. What stood out for me is that as a country, we seem to be ignoring the build to rent, and we are assuming that everyone in this country at the end of the day is going to own a home, which is not a reality, and we need to think and start carrying the people that are going to do the rent to own properties so that it's still part of affordable housing. Number 2, the fact that we keep on talking about new technology, alternative technology. I think we need to realize that it's here, and we talk about it like in the abstract. It's a high time we started talking about it in reality, and that's the only thing that is going to make us embrace it, because when we speak about it from an abstract perspective, then it's out there, but it's happening. And the challenge that the lady from, I think, Surveyors Institute of Surveyors threw is like, we're not talking about it, so we still think it's not possible. Thank you.
2 very important takeouts there. And let me just stay with you with the point number 1. And by the way, this afternoon we'll be having a fireside chat on the rent-to-own conversation. Because this theme has been recurring since day 1, that the Kenyan affordable housing agenda seems to be skewed towards assuming everyone wants to buy a home. What more perhaps would you like us to lay emphasis on, even as we gear up for a conversation on rent-to-own?
I think the one thing that we need to lay emphasis on in terms of rent to own is one, the different professional bodies need to come up with standards, because one of the things that discourages people to live in rental apartments and they want to move to their own is because the facilities are made in such a haphazard way that there's no standardization. Now, if I give an example, most people who grew up in Madaraka, which was a city council facility, remember that those houses were standard. Now, for me, the sad bit is that the construction authority, the professionals and the regulatory bodies have allowed slums in the pretense of rent to own properties. Because if I can be able to get a 2-bedroomed house that has all the facilities and it gives me comfort, I might want to go and build in the village and rent for the rest of my life in Nairobi. So I think the biggest challenge is that we need to be able to standardize the rent to own apartments or facilities that are going to come up. Number 2, we also need to be able to realize that at the end of the day, the rent, that's a rent purely to rent. The rent to own we also need to start looking at it and realizing it's a big possibility. And we are talking about it like it doesn't exist. NSSF does that, and they have one of the best estates in the country. In fact, in Africa, it's known, the Embakasi project. So we need to stop reinventing the wheel and start seeing what are the things that, for example, an organization like NSSF has done well with TPS. And how is it that in the midst of all the chaos in construction, they were able to come up with a project that really is good for living in? Yeah, that's I think, from my take.
So two things, standardization, and the second one is the whole conversation around TPS being the tenant purchase scheme, and that will inform part of our fireside chat this afternoon. Another takeout from yesterday's conversations, the panel presentations, we had so much being brought about in terms of climate change, financing, how do we support, especially the incremental construction taking place across the country. Any? Just raise your hand and, or you want to go again? Sure, please.
Again, financing is one place that is close to my heart. I just want to give an example. Previously, we financed a house that was worth 1 million. The cost came, a 3-bedroomed house that was built in Nakuru County for 1 million. And the lady that we financed was a cook at KMTC. I'm just trying to get to tell people that this is possible. And she had an income of 13,000. But we were able to do a house. That for me is the success story of financing. Now, I have always wondered why is it that in this country we use the long-term yield curve to calculate mortgage loans, and why we can't say that this one, when it comes to affordable housing, we are going to do it differently. Let me just explain as a financial. If you go and get a personal loan today, you get it and you're told you pay within 60 months. And every month you're paying a standard principal and at standard interest. Now, flip it the other side for mortgages, whether it's affordable housing or anything, whether they are at 3%, you still have to pay the bulk of interest before you start paying the principal. And even if you look at calculations that are there in mortgages, at the end of the day, even if you get that loan at 5%, you will still pay double what you paid because of the way we calculate mortgages and how they are paid. So is it possible that we look at it and say, this thing, for us to crack it, we need to change the way we calculate interest on any mortgage, even if it's at 9%, if it's calculated without using the long-term yield curve, because we want to achieve people getting housing. Can we be able to say that we can calculate it and come up with a way of, the way now, the short term, we use the short-term calculation of interest rate rather than the long-term yield curve, because that will make mortgages cheaper. It's not because even if it's 2 million and at the end of the day I'll pay 5 million when I'm done, it's not cheap.
Maybe it would help if you could give us a little more flavor into this case study you've given us around the 1 million house for someone who had a paycheck of 13,000 shillings. Respecting you might have some non-disclosure agreements around there, but just how did the structuring of this financing look like?
Okay, the structuring was like this. I happen to have translated, you know, there's something called the Civil Servant Housing Scheme Fund. Initially, it was just being given by the government. So I happened to have realized that there was a place in the Act that allowed financial institutions to be service providers. Now, what that meant is that because Civil Servant Housing Scheme Fund could only build houses and give them on loan, it meant that the banks could come in and allow people to take out the loans and do houses for themselves and buy. So that was the advantage, and that we were able to get the fund to be both run by the government and run by the bank, the financial institutions. So what we did was we looked at the lady's income, and she could only afford 8,000 shillings to pay for a house. Now, one of the things we did was that we did away with a lot of professionals, because in-house we had a valuer, we had an architect, we had a quantity surveyor who were qualified. So we decided how, and it was more of a CSR project than anything, but for me it just went to prove that it's possible. So what we did was we went and said, rather than ask this person to go and get a quantity surveyor that is going to charge her an arm and a leg, we decided that we were going to just take it and do it in-house. So all costs were taken in-house. The only cost that she was able to incur out of that was the legal costs. So again, it's thinking out of the box and realizing if you have a team of qualified personnel, professionals in-house, why not use them to make housing cheaper?
Thank you. Very, very insightful thoughts there in terms of intervention in the market. I want to prod one of my friends here who has been quiet through the 2 days. Just give us some takeouts you have so far.
Good morning. I'm Stephen Wanjala. I'm a consultant in incremental housing. I've been doing this for the last 16 years across the continent. One of the key takeaway from KWFT MD, and we participated in developing that product for the bank, is the critical aspect that anything that you do, you must always start with the end user, as our sisters just alluded, that we have always to start with the end user, understand what does the end user need, what do they prefer, and what can they afford. Then you design from there, and that is the reverse thinking, which is the most difficult. We will always want to develop, they say there's a housing demand, there are millions of houses required. Supply. It's not a supply problem, it's a demand problem that requires different re-engineering and approaching that by asking, what is this target segment? What do they prefer? What do they want? And what can they afford? Then what should we supply? That is the most difficult. That's my take.
So maybe let me just stay with you for a minute. Given your experience from a Pan-African standpoint, what are some of the markets you would say this agenda of affordable housing is being executed well, and what can Kenya borrow from there?
I think I'm supporting Housing Finance Bank of Uganda. This is one of the biggest mortgage lender in Uganda. Has been in existence for the last 54 years. And it requires a holistic approach. Even an institution that has been in existence for quite a while, it requires right from the board level, senior management, is a whole structuring approach that you'll find the lower segment in an institution. They buy the idea, but how does it translate to the senior management and to the board and governance of that institution? So in most cases we have very good ideas, but we don't touch all the spots within an institution. Then we put timelines, which we are rushing with timelines, but we don't understand that it requires a holistic approach and you must be very patient. So it requires engaging every stakeholder and bringing various value chain actors on the table. Like what we're doing in Uganda is essentially the bank has also seen other opportunities of financing the entire housing value chain and developing products for other value chain actors. Because a house just comes at the end of the tunnel, but there are all these actors which are also financing opportunities. Then that is an opportunity for developing products. But when we only look at the house as the only thing we focus on, why don't we look at the whole entire housing value chain and develop products and being creative and innovative to provide solutions. So it's a holistic approach. That's what is required. And having partnership is key.
Thank you so much. And speaking to the issue of the value chain, yesterday one of the panelists indicated that we look at housing as a product, but housing is a process where you go through the entire construction value chain before you get to the final output, which is the housing unit we are talking about. Let's get more takeouts from yesterday. Any from this side? This side has been quite quiet this morning. Takeouts from yesterday. What stood out for you? What would you like to share with us in terms of what you're thinking through? Any on this side? Yes, there's a hand there.
Good morning. My name is Sheila. I'm from King's Developers. I think the takeout was, first of all, we have not yet sensitized information enough to everybody, from how we were talking how to approach the chamas through the SACCOs, because clearly people still have an issue with trusting a developer. In the grand scheme of things, a developer, we are the last people that a consumer interacts with. And so I think our partners here on board, because I'm pretty sure there are parastatals here, there are SACCOs here, I think there needs to be more sensitization to them, so that when they are introducing us to the consumer, chamas will be a great potential for housing. It's possible to own a house, but also it's good to break down whatever information that we have to them, because also with the Chagamas business model, that was my first time hearing about it. But what if we curate it in the market right now? Because we're a growing market, but all this information we have here, it's much better if we tell also the people who interact with the SACCOs, the chamas, because we don't interact with chamas. It's the SACCOs, it's the parastatals, it's the banks. So if they try to curate something, then they approach us as a developer. I think we'll grow more in terms of the housing. Even the mortgage conversation, still there's so much to be done. And I think if we sensitize enough, we'll get somewhere. So that was my takeout.
Maybe just to stay with you, the question on the Chagamas business model, and that for those who might not have been there, was the Malaysia experience. What really stood out for you about that model? What do you think we can take up as a country?
Well, for starters, in terms of bonds, it's a conversation still we have not yet tapped into, where they are leasing out bonds so that you can, it's another option to mortgage financing. And so how to maneuver that where somebody knows they can go to, is it the CMA, to get the financing? That's something we still need to have more information about, because it was just a scratch on the surface from us, because we were hearing it for the first time, but we need more information about it so that we can explain it to other people, that they have other options apart from, installments, even rent to own. It's an option, but there are always legalities to it that a developer sometimes does not take it up. So if we have something else where somebody knows they have bonds that they can also use to buy a house, it's something nice.
Thank you for that, and for reminding us the issue of raising capital via the capital markets. Maybe I can probably be there to say a thing or two about that.
Thank you, and good morning, everybody. I think that one of the things that stood out for me yesterday was also the Chagamas model, and how they took a high-level perspective, and they said we need to be raising funds each and every single year that they then deploy to the intermediaries who act as agents for funneling the funding. I think for us in Kenya, we actually have these products which we talked about yesterday, REITs and the corporate bonds. One of the challenges that we are facing is the cost of funding. So for instance, KMRC earlier this year raised 1.4 billion. What was interesting about that is that the demand that they attracted was 8.1 billion. That tells you that there was that pool of funding that was ready to actually come and cooperate with them. The second point to this conversation is the funds that we have from the pension funds. So today the pension industry has 1.5 trillion. 45% of this is in government securities, about 20% is invested in the NSC, and then the rest is distributed in other asset classes. So I think the challenge is not that we don't have the opportunities in the market, and I agree with you, perhaps we need to communicate it more, but I think the challenge is then having the developers, having people such as yourselves or people in the industry for housing and affordable housing specifically, then leveraging on capital market products as a funnel for their funding needs. So certainly our takeout from Chagamas is to see how do we then have a conversation where each and every single year, if you are in affordable housing, you're coming to the market, and then corroborating with what our president is saying, that interest rates need to come down. But that's, I think, a conversation that we continue to follow, but we have to be innovative and say, what else can you do to blend your cost of funding and your availability of funding by leveraging on the capital markets? And as the NSC, we're happy to talk to you, to talk to your customers, just to be able to facilitate that conversation. We're open and ready to have that conversation. Thank you so much.
Thanks, Mbithe. And why I brought her in is because she's the Chief Business Officer of the Nairobi Securities Exchange, so all this discussion around issuances, bonds, she's the person to talk to. There was a question raised yesterday around, oh, your hand was up, gentlemen? Yes, there's a hand here, please. Let's get some takeouts from there.
Yeah, good morning, everyone. My name is Ronald. I'm an architect, construction industry. One of the things I take from conferences like this is if you've done research in Africa, 80% of our construction or delivery of houses is done through owner-led construction. So the developer only works on 20%. Yet it seems like the focus is on streamlining that 20% as opposed to streamlining the 80%. So I think as we sit in conferences like this, mortgage is very straightforward. It's an idea that has been perfected elsewhere. But I think maybe we live in a country where we need to rethink what works for us. And if the market, if you actually build a hotel and people are sleeping outside, it should tell you that maybe you need to redesign the sleeping quarters so that people, so that you design for them. So that's one. The other thing that I think about also, which is really African, it's only in Africa where a poor person has two houses. They try to own a home in the city and a home in the village. When you go to foreign countries or developed countries, it's only rich people who can afford a holiday home. So then it means we need to rethink. For an African, for Kenyans, do they want to own a house in the city, or do they want to own a home elsewhere and have somewhere to live in the city? And then provide maybe comfortable living areas in the city. For example, if I don't understand how somebody would want to own a bed-sitter in Ngara, for example, for life. People just want to be there for that period when they're there, but they want to own a house elsewhere. So what I'm trying to say is that we need to innovate based on the real people we are dealing with. And if people are building this way, then even our financing has to focus on that. And I don't see a lot of that. And those are the questions that we need to rethink.
Let me stay with you for a minute. About a year ago, I moderated a conference where the second issue you have raised actually emerged. And the conversation was focused on dead assets in the countryside, where you build your house in the village, you go there once a year, and even the attrition that you see in the house just disturbs you. And a lot of the sentiment we received is that there's some Kenyanese around this sentimental attachment to a house, whether it's in the city or in the countryside. So people just want to buy these units. So the question emerged, how do we then begin to rewire that DNA where we feel that unless I have a house in Nairobi, even if I have assets worth what at the stock exchange and wherever, until I have a house, I don't feel like I've made it.
I don't know, that's a conversation we need to have. And I don't know how many people really think like that, or it's the business of offering houses that thinks like that. We need to go back and ask people, do they really want to own the house, or it's just because it seems like the right thing to do at a certain time when people are doing this? So it's a serious conversation to have. But what I'm trying to say is that we're in a country that we need to ask ourselves difficult questions so that we're not having those dead assets you're talking about. Then we're also thinking about, we just passed a constitution in 2010 that changed the way development is done in this country, opened up the rural areas, so that when you're talking about the rural areas of 10, 20 years ago, it's not the rural area of today. So what does that mean in our changing approach to development for, of residential homes? But I don't have the answers. What I'm just trying to say, these are nice debates to have, and before we design any product, we need to think about that. Yeah.
My final question to you is the 80% you spoke about, that is owner-led development. How do we crowd them into this sort of conversations and ensure that we're not just focusing on the 20% as you?
For me, I think, we, again, are an informal economy largely. That's why we call ourselves a Kadogo economy and all that. We need to figure out how to then streamline that so that it can attract finance. One of the things that you have is, for example, when somebody is building a house on his own, he actually has to manage every contractor, he has to manage every supply of materials and all that. If we can start creating channels that start streamlining that so that there is visibility and accountability in that system, then what Stephen was talking about becomes easy for financial institutions to start seeing financing opportunities along the housing value chain. So that it's not just the developer that is being financed, it's not the homeowner that is being financed, there is the material supplier that is being financed. There is the contractor, the small SME contractor who is trying to build that house and running into challenges of money, and as a result, making the house expensive because it's cutting corners. If we start streamlining that and ensuring we're streamlining the value chain, then financing will come. And technology is a good way to do that. We are the M-Pesa country. It means that we can take advantage of technology to develop unique solutions for home ownership in this country that can then be borrowed elsewhere, rather than just bringing solutions that come from outside and trying to bring them to the country.
Thank you for those interventions. Before I invite the CEO of the KMRC to give us the opening remarks, let's get some final takeouts from yesterday, and including reactions to what has already been said. We are having the issue of owner-led development. They are not being brought into this kind of conversations where we are having on affordable housing. We've had the issues of borrowing from the Malaysia model of financing and what we can do about that. Any final takes from yesterday? What stood out for you? What would you like us to emphasize on? We already have the discussion around renting to own and how we structure that product. We shall be having that conversation this afternoon. Any final one? Maybe let me ask all right, I'm told once we're done with this, then we shall go into the panel conversation. Let me just mention their names so that they're getting ready. That panel will be focusing on incremental housing development, what it takes to scale up. It will be moderated by Sita Shah from FSD Kenya. And we shall have Peter Munyange, United Sacco, Joseph Njoroge from Safaricom Sacco, Benson Kimani from Harambe Sacco, Richard Nyanga from Ukulima Sacco, and Jafford Mwenda from Stima Sacco. That will be our panel right after we finish this. There was a question raised about chamas yesterday, sitting on a lot of capital. We are not figuring out how to bring them into the affordable housing conversation, and yet the gentleman who was seated at the corner there last evening mentioned he has built 700 units out of chama financing. Never walked into a bank, never walked into a SACCO. These are institutions which, though informal, exist in our midst. Any thoughts on how we can bring them into this conversation? Chamas, and I'm sure virtually everyone here must be in one or another. Nyale, any thoughts?
I think to me is the rethinking that we need to do to ensure then how do we tap into that area, because definitely there's untapped area. When you listen to the bankers yesterday, there is an element of needing formal structures like a person, a company, and something like that. But I think there is a lot that needs to be done to rethink and see how else then do we finance these people as a group. And I think that's the model that KWFT does. It gives money to a group, and it puts the pressure to the group to ensure that there is no default among themselves. So whereas KWFT does that to the rural areas and ensuring people also are able to get housing, which is a good thing, in the devolved counties and urban areas, how then do we use that model again to ensure that then as a group they can get financing, either get one mother title, and then they can be able to build, and then as they finish their mortgages, they're able now to separate the titles, and everybody then is out. I think there's a lot of thinking that needs to be done from the financing side to ensure that it's done, but I think it's a good concept.
There's oh, my ashes are out, it seems.
I think when we look at chamas, we have to think of two things. One of the biggest challenge in Kenya is that there's so much distrust when it comes to finances. And the reason why chamas exist is because you want to be able to control what your money does. Now, for me, I think the easiest people to handle chamas would be KMRC. Because if they were to say, we are doing a bond, and that bond will be bought only by chamas, and we give you the confidence that at the end of every year, we are putting it in this project. And at the end of every year, you get 14%, 13% return, or even if it's 10%. Now, because they have the structure, the chamas will have the confidence that there's someone who is watching because of their money. Because at the end of the day, we've seen developers take people's money and they vanish into thin air. So I throw the challenge to KMRC. Why don't they, instead of just going to NSA, and I have no problem with them going to NSA, but why don't they start looking at telling people that have money, the small people, come, and this is a project you're going to invest in, and in 3 years, this is your return. I'll come in as a chama.
Interesting thought there. I'd like to get a response from KMRC. But before that response from KMRC, let me... Oh, yes,
Thank
please.
you. Thank you. My name is Peter Wairegi. I'm the chairman of KPRA. I just wanted to follow up on that. When I was in the US, I was there for about 25 years. The secondary market works in terms of the chamas putting all the loan under MBSs, mortgage-backed security, which then are traded. Then their monies are replenished. Therefore, then they are able even to lend more. So I think bringing secondary market is the way to go. We have formed a company called Nationwide Mortgage Company in Kenya, and we have some investors. So we'll be providing some funding. What we are looking to do is to do a secondary market platform, where then we can go to Chama and other developers and provide additional funding, including going to the capital market. So if anybody is interested in that, they can talk to me. The company is now registered in Kenya. It's called Nationwide Mortgage Corporation.
Just tell us, I'd imagine as you form this company, you've done some market sounding around the chamas. What sort of appetite are you getting from them in terms of what you're trying to spin off here?
Mainly, in any business, they're looking to make a profit. That's the purpose of an enterprise. And I think the chama initially were just supporting their membership, but that is limited. The demand for affordable housing in Kenya is larger than chamas can fill. So therefore, we see the demand is there. The issue, as you mentioned earlier, was the cost of funding. So if we can really bring the cost of funding where it should be, then you will see that we can do the secondary market lending and provide a little more people with affordable housing finance. The last thing also, as part of KPR, is training. Somebody talked about sanitization here. Most people don't know how do you borrow money and what are the pros and cons of borrowing money. So we are going to do, working with KPRA, we'll do a first-time home buyers program, meaning that the people who go through their program actually pre-qualify for affordable housing finance. So training and information is also very key And as many of you know, especially in America, owning a home is the American dream. I think owning a home in Kenya is a Kenyan dream. It's not only an American dream or Singapore. So I think many Africans or many Kenyans are afraid of borrowing because their thought process is that I'll lose the money if I cannot afford to pay. But if you have enough training and sensation, then you can see that we make the borrowing attractive and also affordable.
Thank you. Geoffrey, it has been said that the people best positioned to tap into this MSME, rather the Chama's potential, is KMRC. I know your core business is mortgage refinancing, but any thoughts on that? Are you able to float an instrument and the book building is largely informed by Chamas?
Other than even just looking at the Chamas, I think there's an opportunity for the asset-backed security. And I think that is one of the things that KMRC is looking at in the future, that as we standardize this market, we standardize the mortgage origination processes, then we have a mortgage that is standardized in the market, then that can be packed as an asset that actually will be then availed in the stock market, and then people now are able to invest. Already we have rates, and we just to see how then can we develop that tool to enable even the small investor be able to come and play in that space. So I think there are thoughts that are already going into that space, and I think there is an opportunity for us to develop something that will actually be able to address the needs of that small investor.
Thank you so much. I want to take this opportunity to invite our panelists on set, and as I do that, let me ask the technical team to help me with microphones, because we'll be on this platform. I want to talk about our first panel this morning, that is incremental housing development, what it takes to scale up, and this conversation will largely be steered by members from the SACCO community. So the moderator will be Sita Shah from FSD Kenya, please. Welcome on set. We have Peter Munyange from Unitas SACCO. We have Joseph Njoroge from Safaricom SACCO, Benson Kimani from Harambee SACCO, and finally Jafford Mwenda from Stima SACCO. So let me welcome all of them on set, and let's appreciate them as they come so that they take us through the next 50 minutes focusing on incremental housing development, what it takes to scale up. Sita, I think you want to be on that side or this side? So let's keep our questions as they have their conversation. We'll have a Q&A session at the tail end. Also to those
introduce themselves, and then we can kick off.
Good morning. My name is Peter Munyange, Head of Real Estate in Unitas SACCO.
Morning. I'm Joseph Njoroge. I'm the CEO of Safaricom SACCO.
Good morning, everyone. I'm Benson Kimani.
If you want to chip in.
Okay, maybe I can go first. Before KMRC, SACCOs used to give what we call the development loans, and the tenor for these loans ranged between 4 years and 6 years, and some SACCOs that never had liquidity challenges could go up to 6 years. But for large, a majority of us were doing 60 years. But even before KMRC, some of us, like if I put a case for my SACCO, were still able to do mortgage. We had a mortgage product which we could do for 12 years, and the maximum we could give was 10 million. So we were still in this space even before KMRC. Thank you.
Probably if I can pick it from there, because I think my experience is a bit different from Njoroge's. Before KMRC, Harambee Sacco was not doing mortgage at all. So the mortgage division or the mortgage product at Harambee is a direct consequence of KMRC being in place. So what we are saying is that if we didn't have KMRC, maybe I would not be in this panel today. But we were still doing the other lending, the normal lending, what we call development loans, like he has explained, so I don't need to go back there. But before then, we were not doing any mortgages.
Actually, Benson, could you go into what a development loan is? Maybe people don't understand, so.
You know, the name SACCO stands for Savings and Credit, and the members of the SACCO do exactly that. You save so that you can be able to borrow. So your borrowing is a factor or is a product, or I don't know which word to use there, is determined by how much you saved. Is what we call in the SACCO movement the multiplier effect. So in most of the SACCO, the standard rule is that for development loans, the amount of deposits you've put, you get a maximum of 3 times that. So your part of the deposits form part of the security of the loan, and then you get 2 or 3 other people to secure you the other 2 times that you've added. So that is how the loan is secured. So this development loan, you'll put a reason why you're borrowing, but normally we don't follow you to see what you've gone to do. So you'll find you've indicated it's for education. But like our regulator said on the first day, you'll indicate it is education, but you'll find the guy has gone and bought a plot in Kamuru. So it is used for all diverse needs, education, incremental housing, and all that. So as SACCOs have been evolving, that development loan has now been enhanced in different ways, in such a way that a normal development loan would last for 4 years. It will be 3 times your shares. But you realize that the needs are growing. So different SACCOs now give you different multiplier factors. Like for us, the longest loan you can take is 96 months, and that is 4 times your shares. So maybe someone else can chip in if I've left something out.
Okay, I'll chip in on that. I think fundamentally, if you look even at the statistics in the market right now, 90% of the financing of housing is done by SACCOs. If you look over, it's only that there's a gap in the way we collect our data. Before we started KMRC, we had already an housing or a mortgage book of around just slightly below $1 billion. Right now, from last year, we've grown to slightly over $2 billion in terms of housing. So you look, out of the 90%, 10% are registered mortgages. But as we've been speaking, you've heard there's a push that how do we do housing, or rather, how as a SACCO, how have we evolved just to be responsive to what our members need? Do they need affordable housing, or do they need functional houses? So that we are able to sort that. So as a SACCO, what you can say after KMRC, what came up is that they were able to plug in into a funding gap, because we used to use short-term funds to lend long-term for our members. So what we realized now is that they are plugging into that gap. We are able to do longer-term tenors, and people can afford these mortgages, or rather housing products. There's something we used to do that is called plot purchase. This is whereby you come with a title. This is what even led us to establishing a legal department, because of doing charging and what have you. So to motivate the customers, or rather to control the charges, or rather the charges that are used during the charging process. So that is what we had in place before KMRC, but we really thank KMRC, because that gap that they are bridging, we see a brighter future and a better loan book in terms of mortgages going into the future. Thank you.
That's great. And if possible, we had one slide that could be put up, please. But maybe we could come to Peter, and I really echo what everyone is saying, that the innovation Kenya has is to bring SACCOs into our refinancing corporation, which no other country has done. So let's be proud of ourselves. We've done a real innovation. But all innovations take time, and I love that the conclusion I was hoping to drive has already started, that we need to push for data in a way that we can support market development. So I hope we'll be talking about how to practically do that next year. But if I could ask Peter, please, that he can please talk a little bit about how accessing KMRC financing has helped Unitas to serve its members better, and are there still challenges despite KMRC financing?
Thank you for that. Unitas has a unique model. We serve both the employed and also the SME sector. So meaning we have a portfolio which is largely on T, where we have our background, and also in employment. So meaning these portfolios, we may not be able to tie them directly to properties. But majorly, they take loans and they say that it's maybe for personal development, but these loans goes to maybe purchase of plot or incremental development. On the other hand, we also have the real estate sector, where we are able now to directly engage our members to purchase plots, and they are secured by the same plots. They are able to develop, and also by extension, we are also able to finance people to do rentals. So if you check our portfolio, maybe 30% comes from the secured lending, and probably another 20% will come from unsecured lending, but towards the same real estate development. Before KMRC, we had some challenges because our loans are normally short-term. We go up to roughly 5 years. So meaning you are not able to give mortgages in a way that someone can be able to complete. What we have been doing is to do maybe the incremental developments, whereby you give maybe 1 million, someone will be able now to maybe do a foundation. They will continue repaying these loans up to a certain point, whereby they are able now to get another maybe loan to go to the second phase, like that until they are able to complete. But this one takes more time to complete. KMRC has been able to close that gap. And nowadays, we are able now to give a mortgage in a way that you can be able to complete the house from foundation up to the end. How is it done? We are able to, using the KMRC funding, we are able to give an extended period as compared to what we are giving before. So meaning, if for example, using the data which has been displayed, if for example someone took a loan of 2 million and paying within 5 years, you see the installment could be 47,000. But probably if we give the same loan up to a period of maybe 15 years, you can be able now to maybe to pay an installment of 20,000. So meaning you are able now to get the whole loan, do your complete housing, and up to the end. The other thing is of the interest rate. We have been doing a double digit, but with the KMRC financing, we are able to do a single digit. On the other hand, in a small way, we are able also to engage with the developers in a way that we can be able to finance them using our own funding so that they can be able to do some incremental developments for the off-take. So basically, that is what KMRC has done to us. Thank you.
Thank you very much. One thing I want us to dig into is the fees around the mortgage, because while the interest rate has gone down, do your borrowers still face a lot of fees? Some of you have alluded that you have an in-house legal team. The lady at the back just spoke about how expensive professional fees are. So I would like us to be a little provocative about fees that are required, and how do we address this?
Okay, if I can go on that, is for you to be able to process a mortgage loan, there are various fees that are involved. You start with the valuation fees, you come to the legal fees, and then the stamp duty. So you find it has been a challenge, especially on the valuation fees. The professionals here, the valuers will tell you that whenever they want to do a valuation, they use a scale. How they charge, they use a scale. I think the Valuers Act. When you go to the lawyers, they will tell you they have the remuneration schedule. And sometimes these fees are, I would say, sometimes they are too high. Because if you are talking of affordable housing, and you find that the costs of the valuation, stamp duty, and the legal, they're coming to almost 5% of the cost of the mortgage. That is too high for some of the customers. And where you have a situation where a financial institution is not financing that part of the fees, that the borrower has to go back to the pockets to get this money, is a challenge. So from where I sit, I would like to challenge maybe the KMRC and the government. If we can have a one-stop shop for these professionals, where they'll be able to bring in negotiated fees, particularly on the valuation and the legal, so that whenever you want to do a mortgage, you just go directly to that pool where the fees are not exorbitant, as it were. And then when we come to stamp duty, I know there was that debate about the waivers and so on. That need to become a reality, so that the homeowners, particularly when we are talking of affordable housing, people may be able to access this without not going through a very tedious and an expensive process in terms of fees. Thank you.
Is that the general consensus? Fees are expensive and we should look at other ways?
Totally agree with him. Because right now, it's everybody for himself, and I guess God for us all. Because if it is Njoroge, he has his own panel of valuers and advocates. So he will send his members to them, and we have our own. But there's a thinking around having a common panel for affordable housing, and even have pre-negotiated fees. Because if you look at like the valuers, the way they argue, their valuation is that the first 2 million, I think they charge, is it 1%? So the lowest you can be charged is 20,000. Then they say the balance is 0.25%. So for a loan of 5 million, you'll find you're paying in the excess of 40, 50. And when you look at members like the members that I have of Harambee Sacco, it is a common policeman, it's a common soldier, it's a common civil servant. So those costs have been very prohibitive. But on a positive note, and this is to KMRC, I think we are very grateful for some interventions that I've done after some consultative process that we've had. One of the very prohibitive fee was a stamp duty. And there are two approaches that are coming in. One is the one of 5% financing. And if you're buying a property within Nairobi, normally the stamp duty would be 4%, right? So if I give you 1 or 5%, and that one is normally processed by the advocate, it means the advocate, we can easily cover the stamp duty and also the legal fees. It's a huge burden of the shoulders of our members, which was very prohibitive. So thank you very much for that. And I think with that responsiveness, we are feeling now at home. You remember in the last conference, we were only complaining, but now we are saying thank you. And the other one is we had a challenge with the limits, lending limits. Outside Nairobi, we could only lend up to 3 million. And the members would ask you now, where do I get a house of 3 million? That has been upscaled to 5 million. Within Nairobi, the maximum was 4 million. Now we can do up to 6 million. And those are good developments. So I think it's a challenge that KMRC can take up. If you can have a panel that is negotiated by KMRC, then we have a pool where we can go. I think it would help.
So I think we're putting a lot of responsibility on KMRC, and they can be the vehicle through which we get our voice out, but we all need to lend us support. And we're noticing the very positive developments, but there are others that we still need to work together to achieve. I'd like to pick on the stamp duty. I'm not sure how easy it will be or whether we need to really collaborate to get the guidelines in place, because all that's been difficult is there are no guidelines, and we don't have a integrated database on who owns what in Kenya. So I still wonder how easy it will be, but I know we commit, as everyone on this stage and others here, to work with KMRC and the government to try to enable this. One more thing I would like to push on is the fees. So I've had, I've regretted my journey. I closed a business in Kenya to go study affordable housing finance in the US. And I worked in a fund, and I came back saying, I'm ready. I've not been able to use any of my learnings because the issues in the US are so different from the issues here. If I speak specifically on fees, I'm a licensed ISK, and I find it very hard to practice. I stopped practicing many years ago because I did not agree with this threat of scale fees. And everybody else was cutting corners, but I felt too exposed. So I think as a country, we need to say every market around the world moves towards market fees. It doesn't mean you get poor valuations. It means we need to open up the market, because while we as professionals may be protecting our fees, on the other hand, we're stopping our own families accessing housing. So that's a really key point. One way we managed to reduce legal fees in the fund I worked at in the US was having an in-house lawyer. So our lawyer fees were very low. But that was allowed because professional fees were not regulated. So I think that's also a takeaway for us for the next year. That how can we ensure that professionals are satisfied, give good quality services? And there is a ruling, which is in our regulatory review, there is a ruling that the Competitive Authority has said that these mandated fees are not constitutional. But it's all chaotic and disarray. So that's a really strong point that I hope we can work together on. Because right now, I think if we imagine that each professional may be doing 1,000 house valuations at most, if the market grows and they do 10,000 valuations at a lower fee, they will still be net better, and so will the whole economy. So I really would like to make that point. The other thing I want to ask is something that was really interesting on the interest rate deduction. So far, SACCOs have not benefited the way banks have. So could I ask any of you to comment on that, where you feel we'll be heading towards?
Okay, let me go first. I think one of the things that we need to appreciate is that even before there was a cap on interest rates, the SACCOs have done so much, because anytime that you borrow from a SACCO, you're sure that that rate will not change, or rather the market rates, even if they go up or down, at least you knew that it's a locked rate. So that made sure that everyone was getting funds, or rather anything to do with housing or other products, the rates were locked. So moving into the future, what are we looking at? Of course, as SACCOs, we've tried even to go as far as getting external funding, which the other players are getting, but it becomes hard for us because we are not allowed to trade, or rather to do forex. So it means even hedging those funds becomes a bit expensive for us. So with time, SACCOs have been responsive, and we've really changed to make sure that we meet the needs of our members. but as the regulation from the government, being responsive to the needs or to the evolving needs of the SACCO, for them to be able to get sources of other fundings to be able to bring down the cost of lending. For a very long time, SACCOs have been viewed as alternative sources of funding. But is this the case when you're saying that 90% of the housing needs have been funded by the SACCOs? No. I think it's a high time that also the government moves in and changes, or rather the regulations that we are pushing for a change in are adjusted so that even the SACCOs are able to access other sources of funding, just like the banks or any other players, and for our own lending to the members so that we are able to give them at more favorable rates. That's my take.
Anyone else on specifically the mortgage relief?
Yes, the mortgage relief, if you look at the KRA guidelines, you can only get mortgage relief, the interest on mortgage, if the loan has been disbursed through an institution that is licensed under the Banking Act, the Insurance Act, or the Building Societies Act. So that means as a SACCOs who are registered under the Cooperative Societies Act or the SACCO Act, our members may not be able to benefit from that. So that is an intervention, if made, is to push the cost of the mortgages further down, because the borrowers now will be able to take advantage of that, the mortgage interest relief.
So I think that's the second takeaway we have, that we're going to work together to chart a journey. I thought we heard that there has been positive news on that, but we still need to push to make it happen. So that's one very positive thing we could work on. I would like to ask members on their experience in charging the security, because one thing that is why you are part of KMRC, the fundamental requirement is your loan is secured against a real estate charge. So and that is a big difference between how you're lending and, for example, the KWFT model, where they're not taking a real estate charge. So what is your experience in obtaining the charge, both in Nairobi and outside Nairobi?
Thank you. I think our experience has been, it has been taking too long for us to get the charges. From the word go, when you are doing valuation, you need to probably have a search. Getting a search with the digitization era has not been very easy. So what is happening is that we are taking more time to deliver these houses or the mortgages to our members, in that we have to complete the charge before maybe advancing the mortgages to our members. So we are looking forward maybe to maybe fast track the process of digitization so that moving forward we can be able now to maybe deliver the mortgages faster to our members. In Nairobi, it's taking even 6 months to get a charge. The upcountry, even up to 3 months to get a charge. And of course, that one makes maybe our members a bit discomfort. They feel like maybe we are slow in the process. So if it can be fast-tracked, then it can be very good for all of us. Thank you.
I'd also like to take a minute to talk about this. You know, as I alluded to, I studied specifically affordable housing finance, and there's an amazing course that happens every year where central bankers and government officials come to the University of Pennsylvania, and they'd all come and say, teach us how to securitize. We want to learn to securitize. And the message back from the professor who led it, who worked in emerging countries, she's behind the hundreds of thousands of mortgages that are happening in Egypt and in Malaysia, the Chagamas model. She said, fix your basics. Don't jump to securitization. If your registries don't work, if you can't foreclose, you're dreaming of securitization. And if you go too fast before you have the affordability and the consumer protection requirements, you're likely going to have subprime lending, as happened in the US. So this is an appeal that let's not hide behind the facts we're being told. Registration is difficult, perfecting our charge is difficult, and while we're moving towards the digital registries, can we have data being collected to show what's difficult, and can we have a fast-track process, some parallel process, so we're not stopping the lending. But if there's one thing I learned from my very painful time moving from Kenya and coming back, is we need to work on our basics and not think we can jump before we can walk. So we really commit to that as well, I think. One interesting thing that I'd like to ask is, do SACCO members tend to prepay their loans often? You've been lending in housing a long time. Did people need even the 5 years, 7 years? Did you see a lot of prepayment, or?
I would say, because as I said, most of the members were used to pay their loans within a very short period, maybe 6 years, and the maximum 7 years. And they've been doing the incremental housing, because you come, you take a loan of $1 million, you do the structure, you come back, you take another 500, maybe you do the roofing, and so on. So what you are seeing, maybe from the 4 million loan, we've just started, but what I foresee is majority of them may not go for the 25 years or the 20 years. So in between, they will be able to repay these loans. And the good thing is they're not just repaying to stay idle or do other projects. They will come and repay and take another mortgage. Because the 4 million one is very affordable, because I think most of us here are doing the single digit. So for a loan of 4 million, you'll be able to do deductions of 33,000 or thereabout per month. So maybe when they repay up to 2 million, they will come and pay the balance of 2 million and apply for another mortgage. Because that has been the practice in our industry. Rarely do members pay the loan up to the last installment.
And when they take another loan, do you have the fees all over again? Do you charge again, or can you reuse your earlier fee structure? Or?
Okay, it depends from institution to institution. There are those who will pay what we call the bridging cost, a percentage of the outstanding loan. But now the challenge, what you brought in is, if they are taking another mortgage, again you see they have to undergo the same process of valuation, the legal fees, and so on. So that's why we are saying, if we can have subsidized fees structure, we'll be able to encourage even more members to take advantage of the affordable mortgages that are in the market.
I think another trend that we are seeing in the market is that our model is very different. The way you access credit is you have to get a guarantor. So they are using, even if after you pay this mortgage, they are not discharging the properties. They're using the current charges to get access to other credit even after they finish. Another challenge you are getting is that we are leveraging on data to see how they want to do their housing. 80% of the borrowers want to do their own houses, not to buy ready-made houses. Now that poses a challenge, because now you do valuation when the house has not started, and then after finishing, you need to do another valuation, which is very expensive for someone who's just getting a unit that is not very expensive. So somebody talked about value chain in the construction. So how can we make sure that we close end to end, and that this person doesn't end up using so much? So we are coming up with a model where we have a pre-agreement with the valuer that we will do this in the beginning, we agree on a fee, but when we finish internally we can do a report, and then we can have you sign it off so that you don't have to do it afresh. So those are some of the mitigating or rather innovations that we are coming up with to make sure that the members are able to get a value proposition from our internal value chains. Thank you.
Mr. Benson?
Yeah, maybe just to add on that. Yeah, I'm still Benson, by the way. Maybe just to add on that, my experience is a bit different from them. I don't have any mortgage that has experienced prepayment, because this is the time we are doing our first book. But top-ups are the normal incremental housing model in the traditional SACCO. So you find the prepayment is prepayment so that you can be able to take something more. And now, when you're using guarantors, when you're talking about SACCOs, I'm getting amused when people are looking at us as if you're saying something new. I know we all belong to SACCOs. So, these basics, I think we know them. So if you clear the first loan so that you can take another one, it means you have to get a new set of guarantors. Is that right? So that sometimes becomes a hassle. So what we've done to support that process is that we have introduced collateral lending to our development loans. So that, like he has said, then you can be able to use the same charge and be able to move on. In any case, sometimes the kind of funding they need is a lot. And to get guarantors for, say, a loan of 3 million, it means you have to get 1 page of foolscap and turnover, which becomes a bit of a challenge. So we have introduced collateral lending so that we can be able to support that.
If I could ask about your members who are not on formal pay slips, how do you determine their ability to pay, their credit worthiness? Where do you see that whole sector going?
Thank you. I think what you have been doing is trying to use a document so that we can be able maybe to get the repayment ability. We do this basically using maybe the bank statements to see the flow, or probably how the incomes have been coming through. We also use the M-Pesa statements to do that. The other thing that we do is having a visit to the businesses so that we can be able now to determine the kind of cash flows that they have. Ordinarily, SMEs keep incomplete records, so meaning you have to have a technical team which can be able maybe to come up with income statements and expenditure, and by that you can be able maybe to determine the repayment ability. Thank you.
Would anyone like to add on that? Your use of CRBs, just that's kind of the crux of our lending.
Okay, what we've attempted to do is that, see, unlike the West, in Kenya we've not done so well in credit scoring. And as I alluded earlier, is that the guarantor model is not working, because even when people default, when you try to make these other people pay for them, their pay slips are already overburdened, so they are not able to honor the obligations. So we are partnering with the CIS. We are trying to come up even internally with a scoring engine, where even some of the loans, like the mobile ones, are automated because they are able to monitor how much you deposit, just like the banks do. Also moving forward, because most of the funding, or rather most of the ability now is in the informal sector, you realize that if you're able to track, or rather if you're able to track somebody's savings, even if you're to peg the monthly payment that they do to their savings, you can be able to monitor and know what size of a mortgage, or rather what size of a product they can be able to service. So some of these internal engines, or rather softwares that we are using, we are able to gauge how the informal sector is doing. And for sure, I can tell you there's a lot of money in the informal sector. What we need is just to leverage on how we collect data. And I'm happy that SASRA now is in the forefront, even from the reports that they're asking from us. They are so detailed. You're able now to monitor how the different sectors are doing. So if you can just go granular to the individuals who are contributing to this data, you can be able to score them and give them credit accordingly. Thank you.
Anyone else wants to add? I have a very polite panel. I can't believe everyone's...
Okay, I think from what he has said, technology now is the driver in lending. we would like to use the AI, artificial intelligence and analysis, so that we can understand our borrowers' history, how they've been paying their loans. Most of us have also integrated with the CRBs, that you are able to see their scores. But the future actually is not in the, or our focus should not be on the salaried people. Because in this economy and in our country, I think they are the minority. The majority are those who are in the formal sector. So the challenge is to ensure that we have a way of assessing their credit worthiness. The technology will come in handy. As you do the cash flow based lending, technology, if you plug in technology, the AI, the BI analytics, the credit scoring engines, you'll be able to get a very good credit history for these members, and now you'll be able to even be able to assess their credit worthiness. I would say, like in my circle, 60% of the members that we serve are not employed, and they are the best borrowers, because in terms of even the amount that they take the largest amount of loans. So as we do this conversation, I think, of affordable housing, we should not focus so much on the payslip. Let's focus even on these other incomes. Thank you.
Maybe I can chip in something, because again, this is a space we are getting into. Harambee Sacco is traditionally known as Sacco ya Gava, so it has been the Sacco for civil servants. So we have been on the payslip for the longest. But some time last year, we opened the common bond, because we realized what Njoroge is saying here, that the future is in the business, in the micro MSMEs. So we are getting into that space, and maybe if I can just add 2 more scoring parameters we are using, is scoring back on statements and getting some recommendations from the ecosystem of that business, maybe the supplier or the customers. Thank you.
I also want to add about the chamas. Unitas has been acting in this space, and not all the chamas are bad. Some of the chamas are very good, and out of the total real estate portfolio that we have a good percentage coming from chamas, in a way that they come in a group, they buy a piece of land, after repaying the loan they can come, and probably each and every one will have his or her own title. We have a very good example of a chama in Nakuru which has come together. They have done a project together, and they are able to deliver housing units at a low cost of about 500,000. So it's not all the chamas that are bad. Some chamas can come together and be able to deliver the housing agenda. How do we now come to maybe assess the chamas? What we normally do is that we check on their history. We check on how they have been doing their contributions. For example, they may probably be contributing 10,000 per month, meaning that is money that has been set aside. It's like a saving. So using that kind of a saving, you can be able now to come up with maybe a kind of a loan they can be able to be advanced. So we also use the saving traits in chamas to assess their ability. Thank you.
Thank you very much. I think we're coming to the end of our panel, and we can open it up for questions. I think the one question I wanted to ask was based on the slide, the last one, if you could bring it up, and it's almost a thought rather than... and the question is, even though the interest rate, the monthly installment has halved, or more than halved with KMRC, do we genuinely know the affordability and preferences of our population? So I've highlighted the 4 million unit, and again, this is looking at would a family earning 140,000 gross be able to spend 42,000 for housing? And do we really know that? You know, what we hear, but we don't have a large enough research base is people spend much less than 30% of their net income on housing. Yet the percentage formula we're using is 30% of gross income. And should we work as a sector to demystify this? Because people spend a lot more than we expect on transport, on education, on health, on looking after elderly parents or other relatives. And many people are really working to supplement more than one household. So the parents or the father or the mother on their own is looking after their house, one child's house, you know, in Ruiru, one child's house in Kisii, etc., depending on the job opportunities. So do you feel, and this is particularly relevant with KMRC because there's a cap of 150,000 for the concessional financing. And we also know the concessional financing will end at some point. Every good idea is started with, you know, the idea is you start with concessional financing, then you build the market so that you don't need concessional financing. And also the cost of finance will come down as the market grows and you slowly taper the subsidy. So we know we're not going to have the subsidy forever. So I guess it's a question to the panelists and the question I leave for us. What percentage of the take-home income can Kenyans spend on housing? And it may not be the set percentage for everyone, but is that something we should spend time and money to dig in deeper?
Okay, maybe to start off is, if you look at the installment here, is a variable of two things, the interest rate and the tenor. So first of all, you can play with the two. So if you can bring the interest rate down and increase the repayment period, say for us we're able to do for 25 years. So the 42,000 will come down to around 30 or 31. So by that, you'll be able to have extended that or reduce the burden, the monthly installment from the 42, say to 32. So, and I hope that the concession will not end soon, and if it's something that can be sustained for long, because if it does not stay for longer, the issue of the interest rate now will not be able to bring it down further from what we are seeing, the 9%, the 8%. But in terms of the percentage of the income, what you can put to housing, I still feel 30% might be a good percentage. Because if you're able to settle somewhere, I know even in this Nairobi, the biggest challenge anyone will have is accommodation. But remember, we were talking about the affordable housing, but where is it located? And this actually is a challenge now we are having on the supply side. For Nairobi, for you to get the houses of the 4 million, the 5 million, you have to go on the metropolitan. That is either in Kajiado, Machakos, because I don't think even in Kiambu you'll be able to get the 4 million house. So the conversation we are having on what is affordable housing is even the accessibility of those houses. Because if I buy a 4 million house in Kisilia, then how much will I be spending on transport and other issues? Do we have good schools in Kisilia, or my kids have to come all the way to get a good school in Nairobi? So the issue of the percentage will also depend on how accessible the affordable houses are, because as we speak, the 4 million, the 5 million, you only find it about 30 kilometers outside Nairobi. So if the developers now can be able to do this, what we call the affordable houses, within or at least near the city center or near where the people are working from, then we'll be able to cut those other costs like the transport, so which will be able to be accommodated in the housing budget. Thank you.
Thank you so much to our panelists for that illuminating conversation. Before we get into the Q&A, let me just make a special recognition here, and I'll be inviting him to give some remarks just before we go for tea break, and that is the Member of Parliament for Emuru Dikirr constituency, Honorable Johanna Ngeno Kipyegon. Thank you for being here with us. We really appreciate it. So as we take Q&A, just prepare some few remarks on matters housing. So let's get to the questions to our panelists. You've listened through the conversation around the conversation on SACCO movement, what we are doing, addressing issues of affordability. Any quick questions from the floor? Yes, we have a hand on this side, please. And another one at the back, I think.
Just a quick comment. Your panelist, one of your panelists talked about the majority of borrowers being not employed. I just wanted to correct that. It's a self-employed. When you say somebody is not employed, that means they have no income. But the majority, I would say over 70% of entrepreneurs in Kenya, they are self-employed. They have a cash flow, they have a business, whether it's mitumba or hardware shop. And the way to assess them, you can get their banking statement, you can get their reference. So they don't have that structured. You know, the majority of the people overseas where SEATA was, they have employment and they have income and they have credit. So we need to change the way we underwrite the loans here, using all the criteria, including the 30% of gross earning. That is okay to have a standard, so there's a way to evaluate. But ability to pay is based on multiple factors. One of them, of course, is income. Whether you're employed or self-employed. The other one is, of course, your savings, your asset base, the collateral, of course, the credit. So I think we need to expand that underwriting so that many can qualify. In terms of the comment of affordability, I agree. I don't think you need to go to Kajiado to look for affordable housing. I think you can buy a house within the city, in Kiambu area, in Ruaraka, in Ruiru, and Thika. There are people are building high-rises, townhouses. So you don't have to live in a single family house as if you are a farmer. You can live in a gated community where it's shared compound. Then the cost of that house is cheaper. So it is possible to have a house around Ruiru, Thika, Kiambu area for the 4 to 5 million. So I think once we expand this marketplace, you'll find that we can even do more in terms of affordability.
Thank you. Did I see another hand at the back there? There's one hand there and one here.
It's something that one of the panelists said about building homes that maybe in the CBD or somewhere around the city center to ensure there's effective, something affordable. Just last week we were having a conversation of the same thing when the Regional Expo Summit is going to be happening next year. Something that was mentioned was accessibility of KPLC. The reason why Mombasa has not really expanded, the real estate in Mombasa has not expanded, is because there is accessibility of KPLC is not very consistent in that place, and it's a city. So now, when a developer is looking at such things, they don't find it very convenient to build there because the cost of production is going to be higher. So as I was listening to everyone introduce themselves in the panelists, everyone has, you have access to government, the seniority of your positions, and even Safaricom, the accessibility of your connection. Sometimes even our clients have a problem with accessing these small issues that if once sorted out, as a developer, we won't find a problem just building close to the city center, so long as also the government also reduces also the pricing of the lands. It's not a big problem for us. That's what I wanted to reiterate on the last point that was said about cost of production. About building homes near the city center. It's possible, but it has to be, we have to have help from the other side.
Okay. There was a hand here and another one there and another one there too.
Okay, my name is Anansieta Ndumi.
No, please go ahead.
Anansieta Ndumi, I'm from Mwalimu Assets Management, the investment subsidiary of Mwalimu SACCO. What the point I would like to lean on is on the professional charges. We have a very good gated community in Kitengela, Kisaju. And what I can share is that if you build a good product, Kenyans will buy it. I think every Kenyan has an aspiration to own a home. In the last 1 year, to lean again on that point, 2 years we've actually sold 300 units. And the price range fits very well into the affordable housing, which is between 1.9 to 3 million. Now, the challenge of these buyers is they will get financing either from KMRC, from RBA, from the SACCO, and then they are told you need to add another extra 120,000 to 200,000 legal fees, and I think the biggest is legal fees and valuation. So here is a person who has bought a house for 1.9. They need to add on 200,000 shillings. The financiers are saying, we will only give you the loan for the house. We will not pay for that. And it's a real struggle, and you can see them struggling. So I don't know what the SACCOs can do, what the financiers can do to sort of alleviate this journey to home ownership. What we have done at Mwalimu Assets is actually port the services. We have looked for like-minded individuals whose desire is not just to make money, but a passion for making Kenyans own homes. So if you're a legal entity firm, we tell you, you must be able to service this person who's buying a house of 1.9 million. You can't charge them 30,000 shillings. That's not fair. The same thing with the survey, with the valuer. I think it was alluded to yesterday that if we have a block of one-bedroom apartments, 41 of them, why would you charge every time? And it's the one bedroom, it's the same property. And I think we are ahead of the curve precisely because we want Kenyans to own these houses. Yes, it's a business, but we all have relatives that live in deplorable conditions. And so my call to every partner or stakeholder in this, let us make sure that the supply chain works for our customers. So for the LSK members who are here, for the lawyers who are here, for the surveyors who are here, and for the financiers who are here, consider that charge because it's a very big charge. And we've not even talked about the stamp duty. Thank you.
Thank you for that. Yes.
Okay, thank you very much. My name is Mark Ambito from Third Dimension Architects. And my question basically, or my suggestion just goes up to what the moderator has talked about. I think the greatest problem that we're having in this country is actually access to those areas that we're talking about, like Kitengela, Kisaju, places like, let's say, Kiserian. And I think we all know the cheapest means of transportation. I just visited New Delhi recently, and I found that a metro, a town that's called Noida that was constructed some kilometers away from Delhi, everybody is thinking of going to stay there. Why? Because there's a metro train has been installed there, and so you can just connect to the metro trains and reach the town center very fast. So I think the stakeholders, all the SACCOs, and because we have a member of parliament here, the most important thing that we should be doing to access this accessibility, affordability, is to make sure that we have something like the metro trains, at least within circulating around Nairobi, so that at least these satellite towns can be constructed cheap houses and people can access even the CBD as fast as possible. Unless we do that, then you could be staying there and you take about 5 hours getting to Nairobi. And that's a waste of time for people who are actually productive. So at least my suggestion to you people, engage the relevant people, make sure that infrastructure in those areas are well connected so that at least you can manage to provide for Kenyans these affordable houses within those satellite areas, and people will stay there. Thank you very much.
Thank you. Let's take the final. There was a hand at the back. Final one, then I'll invite the panel back.
Thank you. My name is Pius Kipto from Coop Bank, and my question is how we can improve partnerships between the SACCOs and banks. Currently, the current practice is that if you need to transfer property, banks will not take an undertaking from a SACCO unless the SACCO through goes another bank to issue a guarantee to the bank. So what kind of interventions can we have so that we can accept as banks, we can accept undertakings directly from SACCOs? Because we play very huge role on the supply side through the housing and investment cooperatives. We have assisted them to do a lot of projects, and what we struggle with is on the offtake. And as we know, SACCOs are very good market aggregators. So if we can streamline that area so that as we push on the supply side, you are able to come in a very efficient way and even offtake in wholesale. I believe KMRC, the other issue you need to consider is that most Kenyans, the journey of home ownership starts through buying a plot first. So don't regard mortgage as only a finished unit. So let's also consider buying the plot, then incrementally someone can start building. So I think that is my question on how we can unlock the partnership between the banks and the SACCOs. Thanks.
Thank you. There's one final hand up there, then I'll invite Sita to take over.
Mimi nitaongea Kiswahili.
Sawa.
Tumeongea Kizungu sana, tunasahau Kiswahili. Kwa majina naitwa George Mungau Okonji from the Civil Society. Some 30 years ago, I was the National Secretary of a Housing Cooperative Society. We are the people who came up with the Workers-Based Housing Cooperative Society. Though haikupata nia nzuri ya serikali. Sasa mine is a simple question. 30 years ago, land in Kenya ilikuwa na bei nafuu. So we could talk of housing, affordable housing cooperative society. I don't know whether there is someone from NACHU here. NACHU, there is an organization we formed in those years. I'm an old man, aged over 60. But don't ask me why I'm still here, by the grace of God. Bei ya plot, ama ya plot ya kujenga hiyo nyumba is very expensive in Kenya. The survey we have done indicates that bei ya shamba ama bei ya plot in Kenya iko juu sana in this region, East African region. Enda Tanzania, enda DRC utaweza enda hata uziwe nini a piece of land hata hapa Uganda, wacha DRC. Mimi nauliza the panelist, if we have to be serious on providing the affordable housing, hii bei ya shamba, and one of the legislator is here, tutafanya namna gani ili tupate bei ya plots ama bei ya shamba iwache kuendelea kupanda? Imepanda sana in Kenya. If we have to be serious with the providing the affordable housing, we have to sit down, maybe through the government, and lay down a policy of controlling bay ya plot.
Thank you.
Those are my takes. Thank you.
Thank you. Let me invite Sita to take over as they give their closing remarks and respond to the issues raised. We have 5 minutes.
Thank you. I think that's adequate. I'd actually request all the panelists to give any responses, and then I'll end. So should we start with you, Peter? Okay, go ahead, and then we'll go that.
Thank you. I think I would want to ask to answer the last question about the RAD and the affordability of the RAD. Currently, what is happening is that we have been able to engage developers who are able to come up with a gated community concept. In a gated community concept, you don't need to have an acre of RAD or a quarter an acre of RAD. But what you can have is just enough for you to maybe contract, maybe to have your own house. And this has been made possible through the issuance of the sectional titles in a way that even a smaller piece of land, you can be able to get a title. The other thing is on the apartments. If, for example, you have 50 by 100, you can be able maybe to build even maybe 10 or even 20 houses. But the cost of land will remain constant, meaning the cost of that land is shared among many. So through that, again, I think we are able now to bring the cost of the land down. Because again, on the other side, the cost of land will depend on the forces of demand and supply. I'm not sure whether maybe there can be a control on how someone will sell the land. But again, using those methodologies, I think we can be able now to factor in the cost of land. Thank you.
As we keep getting remarks, let's try address different points or have any point you haven't been able to say. This is your chance.
Okay, thank you. I'll address the issue of the partnerships with banks and SACCOs. Previously, we were working as if we were competing, and I believe the best way to go about it is to collaborate. Recently, I had an issue with NCBA on the issue of undertakings. You keep on pushing. We cannot give an undertaking. We have to have the money first. We have so many things. But I think, particularly because this comes for existing mortgages, which has proper documentations, the only way we should go about it, and I believe, like for CoBank, we should not be having that issue because we are a family. But even for other banks, we also need to understand that we are serving the same customer. We are not competing. We just collaborate on the way forward and agree on the workings. Because I'm sure when you have two legal teams on the other side, we should have that trust that the process will go as expected. So it's, to me, it's more of collaboration and working together. And then on the issue of the land prices, maybe for us as SACCOs, we own a lot of land in this Nairobi and the environs, and we are able to do this through the economies of scale. You are able to buy large tracts of land and subdivide, and the cost actually goes down. So most of the members who belong to SACCOs have very, very many pieces of land. And I think I'll support the issue of now that we should move to the construction mortgages, not the ready houses, because most people will tell you we have land, we don't need to construct. So I share and agree that the next phase should be on the construction mortgages. Thank you.
Sorry about that. I would have wanted to answer the question for my age mate at the back there, but it has been taken, so I'll go to another one of the affordable housing being very far from the center. And I think there are a number of factors that are working together to make it possible. Like I think it is Sheila or somebody who said that it's possible to get those affordable units within. As long as you're not looking for a standalone home, it's possible to get those things. And I'm encouraged by the issue of standardization, because that is one thing that is really going to bring the cost of housing down. Yeah, where you don't have to go and look for your own type of sink, your own type of, because that way you cannot even control the costs. So for me, standardization is going to be a very key factor. And I just wanted to give an example, because I know we don't have much time, that our first mortgage of 3.15 million helped our member to buy a 3-bedroom unit in Kantafu. She used to live in Utawala, so now she has to move further down, or through Ruai, Kamuru, and all the way down. So you can see how that is doing to her disposable income. So we would be very supportive of that, so that, because that, the cost element, the fuel only, would bring what Sheila was fearing, Sita was fearing about. So I think standardization for me is a key one. But just allow me to mention this one. I was just wondering about the possibility, because affordable housing has to create its own space. We are not going to be able to succeed if we are competing with those people who are not in the space of affordable. Is it possible one day, and this is, I'm just throwing it out there, to have model houses? Like say, I want a 2-bedroom house. Maybe the Ministry of Housing has a stockpile that a model 2-bedroom house, this is the plan. I can walk in with my title deed, and they know the location of where I am. I'm able to walk out with approvals without necessarily going to, using the ministry professionals, because I know the ministry has valuers, they have architects, they have structural engineers. Maybe just food for thought. So that I know if I want a 2-bedroom house, it will cost me 1.5, whatever I'm going to build. Okay.
Thank you. I think all the questions have much far been addressed, but I'd just like to touch on how our model seeks to bridge some of these gaps that we have. One of the things is that you need to appreciate that sensitization is not so well done in the market. So one of our pillars is that we do education to our members. And one of the things that we've tried to do to make sure that we reach far and or rather a large mass is that we do even webinars on personal planning. The ideal maybe personal budgeting is that you use 50% of the income that you get on the essential utilities or the basics, then 30% on the wants and 20% on the savings. So this is a narrative also we try to shape, and also we segment our membership, because someone who's retired is different from someone who's starting life, and we try to see how we can shape the narrative of their saving culture, their credit culture, so that we are able to impact on their personal planning. I know in Africa we have a culture of whereby we support even extended families, but does anyone ever get to budget on that? Because that is something that we cannot wish away. So a way of mitigating the financial impact, or rather mitigating the negatives that come with it, is by planning. So it's something we need to look at. And also maybe to allude about the infrastructure, the government should at least support us in this, because if we get infrastructure to these far-flung areas where the land is cheaper, then the multiple, or rather it will snowball to a multiply effect whereby we are able to do many units at a much affordable price. Thank you.
Thank you very much. Mine is to say how privileged I am. I've had such an incredible cooperative panel. It sounds like we staged it, we didn't. And I think we've got our work mapped out. We want to work together to really work for mortgage interest relief for SACCO loans, try to reduce professional fees, help with standardization, and recognize every housing unit typology is necessary. So the SACCOs can really help with the construction and development loans. It's a very different model from the developers, doing very dense units with huge capital requirements. And the ecosystem needs both. And the rural housing, the ecosystem needs all types of housing. So thank you very much.
Thank you to our panel. Asanteni sana. Thank you for your insight. You may resume your seats as we transition to the next session. Ladies and gentlemen, before we take our break, I want to take this special opportunity to invite the chairperson of the Housing Committee in the National Assembly, Mheshimiwa. Please come just briefly, give us some thoughts before guys go and have their tea. This side, please, sir. Oh, even.
Good morning, everybody. Is it afternoon already? I think it's still morning. I'm sorry, I came late, and also came late in the course of the discussion, and I think he also kind of ambushed me. But all the same, I am a politician, and sometimes when you are ambushed, you are ready every now and then. I just don't want to take much time. I just want to introduce myself as Johanna Ngeno Kipyegon. I'm a member of parliament from Emurwadikir in Narok County, and I'm the chairman, parliamentary housing, urban development, and public works in parliament. Most of our roles deals with legislations. And I'm happy. I would have wished to attend this meeting from the beginning, but because of the nature of our work which we have in Parliament, I could not have made it. But all the same, I just wanted to ensure that I attend the tail end so that we can also get to know each other with most of the stakeholders. We as Parliament, we are also stakeholders, and we deal much with the legislation. And I know in most of your discussions, you dwelled a lot on the legislations that are meant to be passed in Parliament to ensure there is a smooth correlation between the mortgagers and of course the people who are on that particular sector. But most importantly, I would have wished to state that, you know, affordable housing is a key factor in the current government. And I think it is because it is provided for in the Constitution that we need to access housing. It is part of the human rights that every Kenyan needs to access or to have access to housing. But how do we deliver that? How do we ensure that we make every Kenyan access at least a house? But not a temporary house, but at least a modern, decent house. So I think the affordable housing came in handy to ensure that at least we can ensure that. And I think even in Parliament, our thinking is that you know, we talk about the retirement pension that people, the savings that we normally have, so that at the end of your retirement, you get some money. What if we turn it into a retirement home, so that instead of getting money, you get a home? How would that be? Because in most of the cases, people who retire, they get some money, maybe 200,000, 500,000, but that just goes to waste. Or even sometimes when you are retiring, you are sick, you are not, you're weak, then it goes to medical services and you just clear it. We are thinking of doing some legislations towards, and sometimes, you know, it's also between the private and the public sector, and of course the concerned stakeholders. Like in some countries, when you get employed, immediately you get your pay slip. You get your pay slip and a key to a house. How if we can do that in Kenya? How do we legislate to ensure that every employee of government or private sector gets a compulsory house allowance? Even if you're earning 10,000, you get a house allowance of 2,000. So how do we make it a compulsory undertaking that every employee gets a house allowance, so that we now take 50% of that house allowance towards the housing? So that if you are working for 30 years, by the time you are retiring, you would have earned yourself either a house or 2 or 3 houses. In some countries also, they legislate to ensure that the employees of both the private sector and the government sector, even those who are in their middle stages of employment, they also contribute towards housing. So I think the provision that we want to build affordable housing is so that whoever wants to own a house can find it easier to access that house, either through his salary or a salary, or even through a house allowance. And which I think house allowance is better than the salary itself. If we could ensure that every employee gets a house allowance and then direct that half of that house allowance towards housing, then the better. You've talked about 144 legislations which are in the House, and we are thinking of introducing an omnibus housing bill which can carry all the legislations that you think can help in changing all this. So I will ensure the stakeholders that as the chair in Parliament, I will make sure that all the legislations that you think has been an impediment in your development will be passed in Parliament. Lastly, somebody talked about the transport system, so that if you are to buy a house in Kitengela or Ngong or these sides of Thika, how is it possible that you have a house, yes, cheaper house, but you cannot access the facilities in town? I think in also the Department of Housing and Urban Development, they introduced what we call NAMATA, Nairobi Metropolitan Transport System, which we thought maybe if we could amalgamate all the buses into certain bus transport and have their own route, which I think in Thika Road they have already marked some parts which the buses will be using, that can be faster. We are trying to make the whole of Nairobi Metropolitan have those kind of transport system. But if we could get a railway, a railway system that can be in all of Nairobi Metropolitan, the better. That can make people who are living outside the city access the facilities in town so easily. I think I don't want to say much. I just want to say thank you for that opportunity of actually to air these few ideas. I will be with you until the end, and of course we will also be sharing either individually or as a group. Thank you very much.
Thank you so much, Mheshimiwa. We really appreciate your thoughts on this conversation of affordable housing. We want to break for our tea, and this should take us for, let me look at the program, 20 minutes. So by 11:30, let us all be back here to start with the next session. You're free to break for tea. Ladies and gentlemen, let's pick whatever we are picking and get back into the hall so we continue with our agenda. So feel free to grab your tea and your bitings and just come inside so that we continue with the program.
KJ, can you hear me?
Shall I call her? So if you talk as you...
Yeah.
She says she's chatting us. She can hear us. But we can't hear her.
Yes. Hebu jaribu kureceive audio yake. Could you talk? Just try to talk again. What? Mimi nisha mute. You, me, and her. Na hao wengine hawezi sikia. Me unmuted. You're not. I'm always muted.
Those outside, please, let's come back in. We want to start our next session. Let's get back into the hall.
One.
2, 1, 2, 1, 2, mic check 1, 2. 2, 1, 2, mic check 1, 2.
Let's make our way back in and settle down.
Hi, Kezia.
Our next presentation will be focusing on positioning affordable housing and backyard rental housing as a key target in Kenya's affordable housing program.
Hi, Kezia.
Hello, can you hear me now?
Hi, Kezia. Yes, no, we can hear you now. Thank you.
You can hear me. Great. Good. Good. Okay, would you like me to start, or is there? I can't quite see what's going on, so I need some guidance from you. Hello? I think for people who are online, I understand that you can hear me, but...
Those outside, we want to start, so we shall proceed as you make your way in and settle down. Tech team, are we ready? All right, those in the house, let's settle down. Let's settle down, calling the house to order so we start our next presentation. High table, you can settle down. So our next presentation will be on positioning affordable housing and backyard rental housing as a key target in Kenya's affordable housing program. The presentation comes from the Executive Director of the Center for Affordable Housing in Africa. That's Kezia Rust. So I will be handing over the program to her to take the next 30 minutes, after which we shall have a quick Q&A. So Kezia, if you can hear me, we are ready to listen from you. Kezia, can you hear me?
Yes, can you hear me? I can hear you, but can you hear me?
Yes, we'll need to boost your sound a bit, but we can hear you, yes.
Okay. Great. Okay, so I will carry on. I have the chat open, so if something goes wrong and you can't hear me, maybe send me in the chat. Okay. Hello, everybody. It's
Sorry,
really
Kezia, just a
great
minute as we try to sort out your audio, please. Sorry.
Okay.
Do we have anyone else in the house who's plugged in on the virtual platform? Because we're getting feedback, so we need everyone to mute so we can hear the presentation loud and clear. Texting and control on the test. We're trying to address the sound issue here. Meanwhile, those outside, let's come in and settle down. We are starting our next session. Let's get in and settle down to get to the final leg of this program. Testing one more time. Kezia, can you hear me?
Hello.
That sounds a lot better. Thank you. Thank you so much. So, ladies and gentlemen, sorry for the delay and apologies to our guest presenter for keeping you waiting this long. She will be speaking to us on positioning affordable housing and backyard rental housing as a key target in Kenya's affordable housing program. Kezia, over to you.
Hello, can everyone hear me?
We can hear you clearly.
Oh, very good. Okay, and now I'm struggling to hear you, but for the next few minutes, that's probably not such a bad thing. But please interrupt me if anything goes wrong or send me a note on the chat and I'll see that. It's very nice to be here with all of you today, and so thank you very much for the invitation. And I'm here with my team from CAF, with Beatrice Mwangi, from 71.4, Ilana Melzer and Jess Breyer, and then Fatou Dia is also online, and then we've also worked with Carol Matiko from Gamarich. And we're very grateful to the World Bank for giving us such an interesting and exciting assignment, and looking forward to sharing this with you today. Moving right along. Here we go. Okay. So the assignment that we were given from the World Bank relates to the rental market, and as we started, the question that was challenged to us specifically was relating to the small-scale landlord backyard rental market, and what does that look like in Kenya? We are aware that Kenya has an extensive rental market, and that's something that people talk about all the time. We know that the National Housing Corporation has been offering units for rent. and that there's other forms of rental, but we were asked specifically to look at the backyard small-scale rental market across urban areas in Kenya. And so the first thing that we did was we took out we took a look at the census, and looking at the census between 2009 and 2019, we were astonished to discover that the growth in the rental market, so the number of people who classify themselves as tenants, grew by 1.6 million households in the course of those 10 years. So that's about 158,000 new urban renter households. That compares with the number of households that identify themselves as owner-occupied households, so they're living in housing that they own, and that was 39,000 per annum. So across urban Kenya, 3.67 million households rent. That's 78% of the urban rental population. So this is not a sideshow. This is the main show. This is how people live in urban Kenya. The next remarkable finding in that space, and it has been quoted in the literature, but just to think about what that means in terms of the implications of how we think about promoting a rental market and going forward, is that 89% of renter households say that they rent from private individuals. So they're not renting from the NHC or from other companies, but they're renting from an individual household landlord, and that was the focus of our work. The first thing that we came into as we started to explore this market and to really understand how it functions and how it's comprised is really this astonishing sense of growth. Because what we also know, and what you've been discussing over these last couple of days, is that Kenya has a delivery rate of about 50,000 units per annum. That's the statistic that we keep on talking about. And yet here we see a delivery rate of about 158,000 units per annum, which are happening under the radar. So understanding that activity has been the focus of our work. Getting a sense of that and thinking about, well, how do we leverage that level of activity so that it starts to support the current priorities of Kenya in terms of affordable housing delivery and the targets that have been mentioned by the PS and indeed by the President, upwards of 250,000 units per annum to be delivered in Kenya. And we have here 158,000 under the radar, and not all of them of great quality. So that's part of the issue that we've been thinking about. Looking again at census data, as well as the income and expenditure survey, community survey data, a sense that there's a real lack on the services side. So just looking in the center here, the main mode of human waste disposal. So only 51% of urban renters have a flush toilet, and of those, only 29% are connected to the main sewer, which means that urban renter households on the ground floor or in buildings there's a challenge with sanitation, a challenge with access to good drinking water. Only 26% have the main source of drinking water piped into the yard or the plot. And again, you'll see very many high-rise buildings in this segment, so how does that stack up? And so on. So a real services deficit, and that contributes to a qualitative deficit in Kenya. What we then did was we took a look at how can we segment the rental that is being delivered, and we identified 6 segments which we classified around the quality of the accommodation, and that's how we structured our segments, again using census data. The first 2 segments are in informal areas, so areas that have been classified in terms of the census as informal. Segment 1 is with non-durable materials, so that would be a classic informal settlement. Segment 2 is durable materials building the rental unit, but still in an informal area. Then segments 3, 4, 5, and 6 are all informal areas, as defined again by the census. Segment 3 is non-durable materials, so it looks very similar to segment 1. Segment 4 is with durable materials, but with non-flush sanitation. Segment 5 has flush sanitation flush toilets, but they're shared, and segment 6 is where flush toilets are not shared. So there you can start to see the distribution of the services that are available. And the segment sizes, I think, are really interesting, that we've got over 50% of all urban renters are living in segments 4 and 5, and living in those particular conditions. The landlord, in terms of the different segments, are private individuals or live-in landlords. In some cases, as we move to segment 3 and 4, they may not be resident within the unit, they may live elsewhere. And by the time you get to segments 5 and 6, they may be perhaps more professional landlords or small-scale developers or companies, less likely to live in the unit or in the building themselves. We then took a look in terms of these 6 segments at the delivery model, about how these units are being delivered. And then also the income and the spend of the tenant households. So in terms of the delivery model, we have segment 2 looking at being funded through own savings. It's an incremental build process, and often by fundi builders, so small scale builders or contractors or masons that are found in the community. There are formal options and that are, so Kwangu Kwaku is a particular model that is offered, or they're built brick by brick in other cases. Segment 3, we would also have the same incremental builds using fundi builders. Segment 4, we start to move on where you have, again, incremental builders, but they're starting to go up as well. And so you have multiple stories in that context. And so there would be engaging with some professional services as well to address those issues. Segment 5 is where tenement buildings start to appear, and in segment 6. And of course, Kenyans would be familiar with those. And can associate them with the categories that are here. In terms of the income, we've got household income and then household rentals that are set out in the different categories along the bottom. And so rentals ranging from about 2,840 Kenyan shillings in segment 1 all the way through to about 12,665 shillings and upwards in segment 6. And so quite a range of rental accommodation prices. And I think what's really interesting here is that these prices would be lower than the build cost that's being delivered by the Affordable Housing Program. So we can begin to understand the particular niche that this market is playing in. What we then did is we took a look at particular neighborhoods, and my colleague Fatou Dia went through and looked at particular neighborhoods within the Nairobi metropolitan area, and took a look at 4 separate areas and plotted the different kinds of segments. And again, for those of you who are familiar with Nairobi, you'll see visually get a sense of how we're actually classifying the different segments. I think what's really interesting and important to note as well is that the segments are not always area distinct. That in some cases you might even have multiple segments on a single plot of land, as the delivery method and the financing method and the accommodation result evolves over time. And there are a number of plots where you have that process of transformation throughout the life of, and you can see that that's happening right now. We had engaged with landlords and with tenants, and then we looked through different neighborhoods. And so just a little bit of a taster, but this is one of the landlords that we met, living in Kawangari. And hers is an example of a property where there are multiple segments on one property. So originally she had a number of shacks. 49 rental units are on her quarter-acre plot, and she owns that plot. So it's a formal area, but it had shacks on it, which she rented out. But then what she did was she applied for a loan from Lesheco, and she started to build units. And she's built, I think it's a 3-story, 2-story walk-up, made out of concrete bricks and has shared ablutions in it. And that's on the same plot. And her goal over time is to replace the shacks with a good building like this. And she's using incremental finance that she's getting, and her affordability for that finance is calculated on the income stream that she's earning from the rental units. So it's a particular product that Leshecho developed in this instance that is recognizing that her income is not a traditional payslip kind of income, but it's coming from the rental units that she's actually developing. And over time, as she gets more rentals in, she will build more. An important consideration, of course, is that the rentals charged in the formally built units are higher than in the shacks. Many of the tenants said that they could handle that and they would quite like to live in a formally built unit. But clearly there will be some people for whom that will be a challenge in terms of their affordability. This is a tenant who is an engineer and lives in a unit, a one-bedroom unit that has its own toilet, and his rental is 12,350 shillings per month, with garbage collection on top of that. And there's a long story here. We've collected a number of case studies like this that we can share afterwards, or that the World Bank will share, I'm sure. But the thing that I wanted to highlight here is why is an engineer living in rental accommodation, and why hasn't he chosen to own? Is it a question of supply or affordability? Well, the key issue here is a question of proximity. So the paragraph in the middle in orange, his priority is to be close to a good school for his children that he can afford. And in that context, he choose rental accommodation that's closer, so that because that meets his immediate concerns. So it's critical that the affordable housing program recognizes his needs as well as the needs of people who are seeking home ownership. And that the opportunity that rental provides is that it already exists, often in very, very good locations. The majority of tenants that, as set out in the census, are walking to work and are because they're living in the proximity of work. And his opportunity to send his children to a school that they can walk to from his home, and eventually, perhaps, he said he would quite like to own, but that would be in the future when he no longer has the immediate need of a good school for his kids. Okay, then in the terms of the neighborhood, these are responses that came from some of the households that were surveyed. And there really is very clear dissatisfaction with the quality of the built environment, the neighborhood itself, not just the units, but also the neighborhood. So we saw incidences of buildings so they use a septic tank for waste, but in order to conserve how many times they need to empty that septic tank, they are letting the gray water run into the street. And that then erodes the existing services where there are roads and stormwater drainages, and where there aren't roads and stormwater drainages, that just adds to the mud and the mess in the area. There is a recognition that living environments aren't good in many instances, and a wish for that to improve. And that creates a sense of an opportunity for a policy that would start to engage on an area basis about how one creates a good built environment within which tenants are living. So moving right along, looking at the policy and regulatory environment, one thing that really struck us and we were quite surprised by is, given if you have 78% of urban Kenyans are renting, and this is a well-known fact that is listed in every speech, then why isn't it addressed within the affordable housing program as a key area of attention? And that seems to be an enormous gap. It was addressed within the 2016 housing policy as a principle, and those principles in that policy are very good. But that policy didn't translate into implementation arrangements that would seek to support and grow the rental housing market. And so we looked at issues around the policy and the regulatory framework in terms of the value chain, so building and refurbishing and redeveloping rental housing, the financing of rental housing, its management, and its taxation and governance. And the gaps within the broad policy and legislative environment is that even when rental is mentioned, the very significant 89% of landlords in urban Kenya are individuals. And that category of landlord isn't addressed in the regulations. In fact, it seems to us, in fact, that the only specific recognition of it is through the tax framework. The KRA has a particular line in income tax declarations that ask individuals to note if they've made income in terms of rental. But from a housing policy and a planning policy, recognizing that it's individuals who are driving the majority of rental accommodation, that doesn't exist. And just to reinforce the point that when we look at the breadth of households and what they are earning, that considering that in the context of the affordable housing program, the majority are fitting right in there. 60% of urban rental households are earning within the range of the low-cost housing segment of the affordable housing program, and another 10% are in the social housing range. So rental at the moment is really addressing this particular submarket, the low-income affordable market. So moving forward, thinking about, well, how do we address this reality, and how would we engage with this within the context of Kenya's affordable housing program and the commitment to really driving the delivery of housing that meets the needs of low-income earners? The principles on the left, scale, affordability, investment, sustainability, local relevance, those are the principles that underlie the affordable housing program broadly. We want to see scale delivery. We want it to be affordable to low-income households. We want to bring in private sector investment to couple with government's investment. We want this to be sustainable over the long term, so not a once-off. And it should make sense at a local level. So understanding that and thinking about it in terms of the rental context and what we understand from rental households, we are promoting a massive small approach that really recognizes small-scale landlords, those individuals who are delivering it right now, and thinking about ways in which their activity can be improved, both in terms of quality and scope and their situation within the built environment. There is a built environment, and so we wish to pursue and to leverage existing assets and to recognize that those exist right now, and addressing the quality deficit does not necessarily mean that one only has to build new, but one can engage with what's existing there. There's a critical need to address issues of risk and return, to bring the private sector in so that they can engage in this market at the level of scale that is needed. And as I said, we need to elevate quality, and all of this needs to fit in an area-based approach. So we've developed a proposal that includes five key pillars. The first one is recognize rental. We're saying count rental towards the affordable housing delivery program goals. Now, currently, the 158,000 are not of the standard that would be expected by government when they champion and say we facilitated the delivery of 250,000 units per annum. But some of them are close, and some of them could be improved and renovated to the point where they are worthy of counting. And this is a level of activity that's growing. And so the first recommendation is to say, put this in the policy, address it, and address it in terms of the way that it currently functions, in terms of the nature of the landlord, the expectations and the capacities of the tenants, and then the current deficits that exist that need addressing. The second one relates to prioritizing service delivery. And there it's about bulk infrastructure prioritization and funding and delivery specifically into the availability of services, water, sanitation, and power, as well as roads and connectors, and then the broader urban infrastructure. So that's a second priority. The third recommendation is about enabling construction quality. And we really don't want to say that the rental that is currently found, no one agrees that that's adequate. It is inadequate. We've seen that. But it exists and it can be developed better. And there are developers and individuals who are building constantly every year. And if we can harness that delivery effort and guide it towards quality in a particular way, that's an energy that the current affordable housing program doesn't contemplate. And we feel that that's worth wrapping our arms around. The fourth recommendation is around clarifying and capacitating roles, rights, and responsibilities. And that relates to the relationships between landlord and tenant. What it also relates to is the relationship between national and county and then landlord. The role of the financial institution relating to the landlord and the tenant, and then the governance framework, that whole thing. So that's about addressing the policy and the regulatory barriers, but beyond that, the implementation barriers. And there are a number of areas where we've identified specific attention needs to be paid. And then the fifth proposal brings all of this together into a pilot approach. And that pilot approach has two areas of focus. The one is on inner city area-based urban regeneration and the renovation of existing buildings. And the second is on new build, but it's recognizing urban infill opportunities and championing the entrepreneurial landlords who would be classified as individuals in terms of the in terms of the census as the drivers of that process. And in order to do that, we've recommended a number of interventions that relate to our recommendations 1 through 4. So that's about service delivery, about infrastructure, about building quality, and about recognizing their participation. And we're recommending, first of all, that we have at an area base, the way in which you do that is you create the technical capacity that can support around quality, and that may be, that's non-governmental. It could be private sector led, but supports around quality and access to building materials and building plans and recommendations about best practices about how to build and how to renovate and towards quality. And then secondly, an area-based office at the sub-county level that would expedite the approvals and that would focus on the kinds of regulatory role that a sub-county government would have to make sure that quality and service delivery and area movement is all addressed. So this has been a lot to go through, and I just want to show a little bit about what that might look like. And we've developed, we've taken a look at one of those case studies, and this is in the Mwiki area. And what we've taken here, and this is as an example, but something that you can imagine that a local office could do in terms of creating the visioning and then the opportunity, that the visioning to say this is where we want to go in terms of the development of this area, which then brings in the lender who can see, I can build a product around that. And it brings in the building material suppliers who say, there's going to be development here, we'll bring that in. And you get an area-based focus of all the different players within the private sector and the NGO and community sector, and they start working together. And then there's an area-based governance, regulatory, and administrative office that they interact with. So here, what we've done is taken an area view of Mwiki, and then superimposed upon that how it might grow and change when we start to think about an area-based regeneration approach. And in thinking about that, what Fatou has done in her analysis is to take a look at an area and say, well, what of the buildings are ground floor only? So this here, what of the buildings in that same block have a first story? What have a second story and a third? And then look at them one by one. What is the intervention that needs to be made to start to improve issues like the access to services, the quality of the construction, access to light and space, the movement around the building, its relationship also to the road, and so on. And taking that further, starting to look at particular plots and investigate what's possible there. So what we've done, and this is again something that that local area office could do with a particular landlord and a set of investors, is to say, let's look at the plot. How does it sit? How does the building sit on the plot, and what's possible in terms of the current building regulations and the current zoning guidelines? And within that, how can we start to work out the building map, as well as, and align that with a set of delivery principles in terms of what quality means, to then say, well, what is the investment ask, which then would create the opportunity for a lender to come in. And so taking a look at that, a range of options arise. And when you do it in this way, you can begin to see that there's more opportunities. For example, in the area, there's more space for, in fact, for density. It looks now like a very dense area, but with better use of the space, one could actually put more units in. And if you do that, then you improve the yield so that it becomes a viable development. So looking specifically, for example, at this corner unit here, where you can see that there's shops downstairs and then there's rental upstairs. Well, what is the next step that you can take from that? And what is the asset that currently exists? So that's important for the lender to understand. What are the planning and the services implications? And are those being met in its current instance? And what are the opportunities for growth? And if we move further, we can then say, here's the building again. Well, phase one, it was built in 1998, and that's as it exists. Phase two, add a few shops to that, and those shops start to service the possibility of affording the next investment that's made. Then phase three would include some rental units together with the shops. Then phase four, you go up and you improve those. And each of that becomes an incremental process that within the incremental delivery, each phase is internally cohesive. So that you build towards the opportunity of future. We make this argument quite strongly because these units and these neighborhoods exist. And there's already investment activity that's happening, and that people are wanting to invest in it all the time. And you have all seen this wherever you drive across Nairobi and in other cities in Kenya. But there is a real need to offer support in terms of planning and quality development, and good ideas, architectural ideas in terms of what would maximize the living environment within the affordability constraints of the tenant. Another example here, this is a medium-rise residential on a middle plot, which someone has just built by themselves already. So how do we then support that so that the quality of the accommodation inside is improved, and so it contributes better to the neighborhood? This example here may well have been, when it was built, one of the in situ new builds, which is invested by a small-scale landlord who has a vacant plot that they can then go and build in. And with a local focus of a local office that understands the configuration of the street and understands how that relates to the functioning of the local urban economy and the supply chains that enable the delivery of the building materials and the labor, that has access to understanding what finance might be available, we can improve the efficiency of delivery that right now is already outpacing the affordable market by 400%. So it seems to me that there's a huge opportunity here to really engage with the rental market. And in some ways, it's already a moving ship. If we do nothing, it will carry on delivering as it is right now, and that's substandard. So the critical opportunity and responsibility is to engage with this subsector of activity, recognize that it's happening, and provide it with the support, whether financial or regulatory policy, that's needed so that it's done well. And in doing that, you're actually going to meet the needs of the affordable housing target market. And I'll stop there. Thank you very much.
Thank you so much for that illuminating presentation, which focused on positioning affordable housing and backyard rental housing as a key target in Kenya's affordable housing program. So we'd like to take some questions to the presenter. Just as usual, shoot up your hand, introduce yourself, and throw your question, just one question because of time. Any from the floor? Yes, we have a question here. So let's just have a microphone taken to her and we take that question. Any other? We want to mark them up so that she can respond at once.
Okay, thank you very much. My name is Beatrice Menjo from Wasengishu. My question is not really a question, it is a concern. From the presentation, the presenter gave us the categories of the rent paid by the tenants. She categorized from 1 to 6. So we had the category 1 are the ones who pay 2,000 per month, and she went all the way to category 6, those who pay 12,000. So on the issue of affordable housing, what are the financials doing to accommodate this tenant who pays 2,000 per month, so that we can give them habitable, affordable house for ownership? Because if they pay 2,000 per month, it means when you look at the category of the house they are living in, maybe it is not all that habitable. So what can we do to ensure that this person who pays 2,000 shillings per month can access an affordable house that is habitable and safe for living? And this is a question that I'll throw to the financiers, the banks, the SACCOs. They look at that, because I believe 70% of the people living in the urban areas are that category of people who pay between 1,000, 2,000, 2,500. But when you look at the living conditions in those houses, it's pathetic. So the KMRC and the partners should come together and think about these 70% of the urban population who are living in very poor cost houses, and what can we do to improve their living standards by giving them better homes. Thank you.
Thank you for that. Any other reactions to that presentation? Yes, we have a hand here.
Thank you so much. My name is Ronald Omyonga from iBuild. Kisia, I'm very grateful for that presentation, because it highlights one of the things that we've talked about, the role of affordable rental in meeting the housing gap. And I think that for me is a good presentation to ask us questions about what you're doing to deal with that. But I just wanted to ask something else that you might have tried to inquire. Churches in this country, especially mainstream churches, own a lot of land in very in terms of where they are located. Is there any study that has been done in where churches can partner with the private sector or even the government to deliver affordable rental, so that we, even as we are thinking about regeneration and building inside existing places, can we take advantage of the land that lies idle within the boundaries of the city? Thank you.
Thank you, Ronald, for that question. Any other before I invite Kezia to make her comments? Yes, there's a question at the back here.
Thank you. My name is Peter Mugo from Epic Properties. I think this is one of the best things it's my take home from this that presentation. I think what has happened is we've not taken fact that a lot of people still pay rent and they're going to pay rent. And one way of addressing the issue of affordable homes would be, one, the 89% landlords who own these houses, if they encourage to make changes or refurbish or improve these houses, either through small affordable loans, and then they are able to sell the same unit to a group of chama, so that then if you have 49 units like that lady in Kawangware, she can look for a chama who will own that 49 units, buy from her, and since that's her business of doing rentals and converting them or making sure that because she understands the business, then it becomes a revolving way of ensuring that most people end up owning a unit. For instance, you'll have the 49 houses bought by 20 people. Each will have 2 houses. They move to the next project. They'll have another 10 units owned by another 5 people, each owning 2 units. And in the long run, you'll have majority of the people owning homes within the CBD, and they'll be able to live in decent and affordable homes. Thank you very much.
Thank you. Kezia, do you want to make some quick comments responding to the issues raised?
I'm so sorry, but I actually couldn't hear. It was so distorted. I tried to read lips, but I couldn't do that either.
Oh, sorry
Maybe
about
if you
that.
can summarize it quickly.
If you
The
can hear
sound
me,
very-
there was a question around whether a study has been done around potential partnerships with churches which own tracts of land across the city of Nairobi, and seeing how this can be used as one of the avenues through which we can scale affordable housing.
You know, I can't hear that either. I can't, the sound is so distorted from you.
Sorry about that. I think we shall close it at that. Let's take those questions. We can send them over via text and then see if we can get a response from Kezia. Thank you so much for that presentation. Because of the technical challenge we've had there, allow me to usher us to the next session, which will be a fireside conversation involving the discussion on rent to own. So let me take this opportunity to invite Peter Mwangi from Walker Contours Advocates on set. Also, Washington Agutu from the National Housing Corporation to come and join me on stage if he's with us. Karibuni. I wish we had removed some of the seats earlier, but just take a seat there. Washington, karibu sana. You'll have a seat here. Could I have 2 mics, please, for my panelists? So we want to make this extremely interactive. One of the issues which has stood out in this conference is the subject of rent to own. So we really want to have the panelists give their thoughts. I invite you to give questions intermittently, not that we have to wait until the tail end. So let me start from here. For those of us, my parents, for instance, were civil servants, and the first way in which they acquired their first house was through a rent-to-own arrangement. So for someone who is in the audience and they're not familiar with this, let me start with you, Peter. What is rent-to-own?
Good afternoon, everyone. Yes, rent-to-own, or if we may, the tenant purchase arrangement, is a plan or an arrangement where, as you occupy the house, you have an arrangement where you actually buy the house that you are occupying over a period of time. So you have a contract with obviously either the developer or the person who is selling the house to you, but rather than pay outrightly at the beginning, the arrangement is such that you pay a deposit towards the purchase. You agree on a purchase price so that you lock it, pay a deposit, agree on a time period. Typically, it actually varies from 5 years to some going up to 18 years, where you can be paying over time. You building interest rate over that period. I have seen interest rates ranging from 8 to 13 or 14% over the period of time, and the ownership will be transferred to you once you pay the full amount. Again, you can also have an arrangement like the rent to own, where you come in, you lock in, you pay a lock-in, you agree on the purchase price, you pay a lock-in fee, and then you have an option. That option will be exercisable after a number of years, so you are not paying the installments at that point. You are paying rent, but you have an option which you can exercise as a tenant. After some time, once you exercise the option, then you are then able to buy, because at that time you have built your credit and you're able to get financing for a mortgage.
Peter, let me take us slowly. So let's break down a few of those issues you have mentioned. First, and let me bring in Washington at this point. You have spoken about a lock-in, which sounds pretty much like a deposit. So the question, because I was moderating a conversation on rent to own just a month ago, the question which typically emerges is, how do we determine this lock-in amount? What percentage of the agreed value of this unit should it be, Washington?
Thank you. Maybe some of the instruments that my brother is talking about may be foreign to what is actually happening in this country. The issue is the rent to own or tenant purchase arrangement was introduced to this country by National Housing Corporation. Whether you're buying a serviced plot over a period of time, or you are buying a house over a period of time. And remember, high-rise buildings ownership came in 1989. So before, it was either a maisonette or a bungalow. A property or an estate was developed, price given, and you are asked to pay 10% deposit. Once you have paid the 10% deposit, you move into your house and you pay mortgage normally. Now at an agreed interest rate, monthly installment. Every payment that you make per month goes towards paying the principal amount, the interest that has been charged on that property, and service charge. So that one would not say it is a locked-in. You just pay a deposit of 10%, and it is known that is part of the purchase price. Thank you.
Washington, let me stay with you. I can imagine in the audience you might be wondering, so what's really different between this and the mortgage?
The difference here is that as for National Housing Corporation, the interest rate does not change, but the principal amount reduces with time. All right? So it is like you fix the interest rate, you fix the period, if it is 10, 15 years, 5, or 25 years as we are doing for social housing. And therefore, the difference is that interest does not change. It remains